He watched his company stock climb for years. 200,000, 500,000, past a million. At the top, $1.8 million in gains. He still did not sell. From the outside, that sounds like greed. It was not. The decision that wrecked him started years earlier, on a different chart with a different kind of pain. He had sold another stock after a recovery because he thought he was being responsible. Then he watched it keep climbing without him. Double, triple. A clean, sensible decision turned into a private humiliation. So when this company stock started becoming real money, he made a vow that felt disciplined and ended up being lethal. He was not going to make the same mistake twice. He held when the gain grew larger than his salary. He held when it grew larger than the mortgage balance. He held when it became the kind of number that changes how a family pictures its future. He held when his wife said this was too much in one stock. He held when an advisor suggested moving part of it into index funds. He held because selling early had once made him feel stupid, and this time he wanted to feel strong. Then the stock started bleeding lower. Not a movie crash, not one horrible candle, just a long staircase down. Week after week, the old high stayed in his head, while the real account got smaller. On Reddit, he wrote that he could not stop replaying it. That line is the whole video, not the money, the replay, because this is not just a story about one investor freezing at the wrong time. It is about how regret can train a careful person into concentration risk, how a smart household can quietly become a one-ticker household, how the brain keeps calling that caution while the danger gets bigger. The case is real. The pattern has a name. And it matters because most people do not lose control in one dramatic decision. They lose it in a series of decisions that feel almost reasonable. Here is where the trap starts. He works in tech, which means part of his compensation does not come in plain cash. It comes in company stock. RSUs vest. Employee purchase shares accumulate. In a good stretch, the package feels less like compensation and more like a fast lane to freedom. Then the stock hit a rough patch. He saw the drawdown, told himself he would be rational, and made a clear plan. If the stock gets back to this level, I sell some and lock it in. Eventually it recovered. He followed the plan. He sold a chunk. In the language of personal finance, that was the responsible move. He had taken risk off the table. He had realized the gain. He had done what disciplined investors say they will do. Then the chart kept running without him. Every week after the sale felt like a fresh insult. The stock doubled past his exit. Then it kept going. The screen kept showing him a version of his own life where he had done less and ended up with more. That kind of regret is brutal because it does not feel like a market mistake. It feels like a character flaw. He was not replaying a reckless trade. He was replaying restraint. And once that feeling gets into your system, it starts rewriting future decisions. Selling stops feeling prudent. It starts feeling cowardly. Missing upside starts to hurt more than carrying risk. So the next lesson he taught himself was simple and dangerous. Do not sell the winner too soon. Do not be the guy who exits and then watches the stock keep climbing. That rule was not written in a spreadsheet. It was written emotionally. Emotional rules are powerful because they feel like wisdom earned the hard way, which is why the second phase matters more than the first. The first sale cost him money in his head. The second lesson cost him judgment. Once that lesson hardened, every future vest, every new share purchase, every run higher in the stock fed the same belief. Be patient, be loyal, hold through it. This time, do not flinch. That is how a position becomes a household. Not through one reckless purchase, through 100 quiet yes decisions. New RSUs vest and stay in the account. Employee stock purchase shares settle and stay in the account. A bonus lands, and instead of reducing the position, it becomes one more reason to wait for a better sale point. The pie chart changes so slowly that the danger hides inside familiarity. First, the stock is a meaningful slice, then a big slice, then the biggest slice, then the rest of the portfolio starts looking like background noise behind one ticker symbol. The image I keep coming back to is a kitchen table Laptop open, company chart on the screen, wife across from him asking a normal question. How much of our future is sitting in this one stock? Not a fight, not panic, just a clean question. Later, there is another version of the same scene in an advisor's office. Diversify some of it. Use broad index funds. Reduce the concentration. Again, perfectly normal advice. Again, it bounces off because by that point, the company is no longer just a line on a statement. It is the salary deposit. It is the vest notification. It is the ESP purchase confirmation. It is the badge at work. It is the manager saying the quarter was strong. It is the product he knows, the business he hears about every week, the internal story that feels more tangible than some index fund made of names he barely thinks about. When the same logo pays the bills and inflates the brokerage account, concentration puts on the costume of safety. Selling some of it does not feel like reducing risk. It feels like stepping away from the one machine that has already been carrying the family. That is the inversion at the center of this case. The concentrated position feels safer than diversification because it is emotionally familiar. The outside fund is the abstract thing. The company stock is the thing with a paycheck attached to it. It already recovered once. It already punished him for selling too early before. It already turned ordinary compensation into serious money. So familiarity starts impersonating evidence, and his wife is usually seeing a different map. He is looking at the company story. She is looking at the family balance sheet. Same company funds the paycheck. Same company funds the brokerage account. Same company is underwriting the retirement picture. They have both started to trust. If something goes wrong there, it is not just one asset that gets hit. The pressure shows up everywhere at once. Income risk, savings risk, mood risk, timeline risk. That is why the question at the kitchen table matters so much. She is not asking about ticker conviction. She is asking how many parts of the house are secretly connected to the same pipe. By the peak, the gains are not just a number on a chart. They are attached to real things in the family's life: mortgage payoff, school fund, retirement timeline, the margin that makes a household feel hard to break. There is a version where the number even starts blending into monthly life. A good quarter at work feels like the account should be up. A bad week in the stock changes the mood at dinner, even if nobody says it directly. The line between employer and family fortune gets thinner and thinner until nobody inside the house can really tell where one ends and the other begins. And because the chart is still rising, concentration does not feel like concentration. It feels like conviction. It feels like patience. It feels like being rewarded for staying calm while other people would have panicked. From the inside, none of this feels theatrical. Nobody wakes up and says, I want 80% of my family's financial future in one company. They wake up one day and realize that is what they already have. The salary depends on the company. The equity depends on the company. The household mood depends on the company. One symbol has quietly taken up too much territory. Then the market changed, and the whole story went slow motion. The stock did not collapse in one afternoon. It leaked. First came the kind of decline people dismiss easily: a few red weeks, then a bounce, then another leg down. In a fast crash, panic has clarity. In a slow grind, hope stays alive too long. Every step lower gives you a fresh excuse to wait. A slow decline also creates rituals. You check pre-market before coffee. You open the app at lunch. You compare the new number to the old screenshot in your head. You do the same math again. If it just gets back to here, I can still fix this. If it gets back to there, I can sell some. If earnings are decent, maybe the market remembers what this was. The chart becomes less like information and more like a conversation you keep having with yourself all day. It was higher last month. It recovered last time. Earnings are coming. Maybe this is tax selling. Maybe the market is overreacting. Maybe I should at least wait for break even on the last batch. Then break even on the average cost. Then break even on the whole position. That is when the language shifts. The question stops being, is this still a good risk for the household? It becomes, how do I get back to the old number? And break even is addictive for a reason. It sounds sober. It sounds disciplined. It turns an ugly judgment call into a clean scoreboard. At break even, I can tell myself I was not wrong, just early. At break even, I can exit without feeling like I surrendered. At break even, I do not have to say out loud that the old peak is gone and I should have reduced this earlier. The target feels financial, but underneath it is reputational. Break even promises emotional absolution. For him, that ghost was $1.8 million, not cash in hand. Worse than cash in hand. A vivid, maybe, a version of the future he had already started spending emotionally. You can show that loss better with objects than with finance jargon. A mortgage statement, a school folder, a retirement date circled on paper, a renovation sketch, each one tied to the old peak in his mind. Then the counter runs backward and the objects start disappearing. This is the part people underestimate when they talk about paper gains like they are not real. Of course, they are not realized. Psychologically, they are very real once you build a future around them. He wrote that he could not sleep. He wrote that he kept replaying what the position used to be worth versus what it was worth now. That replay is not one dramatic movie scene. It is a loop. Old high, current value, old high, current value. What if I had sold then? What if it bounces now? What if I sell and it rips again? What if I hold and it keeps bleeding? That is how a portfolio becomes mental static. That is not the language of a gambler. It is the language of somebody watching his own judgment dissolve in public and private at the same time. And the cruel part is that there is rarely one clean day when the decision obviously flips from patient to irrational. Down 10% can still look disciplined. Down 20 can still look like conviction. Down 30 can still feel like holding for a recovery. A small bounce does even more damage because it refreshes the whole fantasy. See, I was right to wait. Then the bounce fails, and now you are even more attached because you already felt the relief once. By the time outsiders can clearly see the trap, the owner of the position is usually fighting a different enemy. Not the market, the shame of locking in the mistake. This is where the science actually helps, but only after the pain is on the table. The pattern has a name, the disposition effect. Schefrin and Statman used it for the tendency to sell winners too early and hold losers too long. On paper, that sounds almost childish. In practice, it is one of the cleanest descriptions of how money turns emotion into portfolio policy. When a position is up, selling feels like relief. The gain is visible, fragile. It can disappear. Hitting sell feels like protecting something you already own. When a position is down, selling feels like confession. The loss stops being temporary and becomes official. Holding lets the mind keep one door open. Maybe it comes back. Maybe the market is wrong. Maybe I just need time. Kahneman and Tversky showed how much more intensely people feel losses than equivalent gains. You can see that bias in one gesture. Green position, quick sell. Red position, hand hovers over the button, then pulls back. Then regret makes it worse. This Reddit case is not just classic disposition effect. It is disposition effect after emotional scar tissue. He sold early once, hated how that felt, and learned the wrong lesson from it. The first mistake trained the second. Large studies found this is not rare. One well-known investor study found around 85% of investors were more likely to realize gains than losses. Odion found that the stocks people sold often outperformed the ones they kept by roughly 3.4% a year. That is not a personality quirk, that is a long compounding leak. The most toxic part of it is the reference price. People start treating their own entry point like sacred information, even though the market does not care what price made them comfortable or embarrassed. A winner above entry feels like proof they were right. A loser below entry feels like a wound that can still be erased if they wait. Break even starts to feel like an emotional pardon, which is why this bias survives good advice. Just diversify is logically correct. It is emotionally weak against a brain that is trying to avoid humiliation, not optimize expected return. If this were only one Reddit confession, it would still be useful. But the same script keeps showing up inside much larger tragedies. Enron is the obvious example because it compressed the whole pattern into one catastrophe. Employees were not just betting on a stock, they were trusting an employer, a culture, a status story. The company was not some random ticker on CNBC. It was the place they worked, the badge they wore, the building they drove to, the thing that made them feel like they were on the inside of something important. That is what makes the visual so brutal. Imagine a retirement statement where one name keeps taking up more and more space because that name has been winning for years. Imagine decades of work translating into one concentrated pile because the company felt smart, modern, admired, unstoppable. Then the company implodes. Around 20,000 employees lost about $2 billion in retirement savings. For some employees, there was even a period when their retirement plans were effectively frozen during a planned change while the stock was unraveling. So the experience was not just loss, it was loss with the feeling of being trapped inside it. One of the names that still sticks is Charles Prestwood, roughly $1.3 million in Enron stock built across decades of work. Then about $8,000 left, one before and one after, and a lifetime gets flattened into a number pair. That is why these stories stay lodged in memory. They translate career loyalty into two figures on a page and let the gap do all the talking. Nortel had a similar shape in Canada, a national champion, a company people thought they understood, a stock that had once looked untouchable. For a lot of employees and ordinary investors, Nortel was not a speculative flyer. It was the respectable answer, the serious answer, the stock you could mention at a family dinner without sounding reckless. Then the chart went from around $124 to roughly 67 cents. Different country, same emotional structure, familiarity posing as safety, pride disguising concentration. The meme stock cycle made the same wiring visible in a more theatrical costume. People sold early, felt mocked by the continued rise, swore they would never make that mistake again, then turned holding into identity. Diamond hands sounds funny until you notice what it does. It makes selling feel like betrayal instead of risk management. Once a trade becomes a membership badge, the exit is no longer just an exit. It feels like admitting the tribe was wrong, your read was wrong, your screenshot phase is over, your status inside the group just got downgraded. That is why these examples belong together. Enron is the workplace version. Nortel is the national champion version. Meme stocks are the online tribe version. Different clothes, same nervous system. In every case, the position stops being only a position. It becomes a loyalty test, a patience test, a self-respect test. Once that happens, the numbers stop feeling clean. A falling stock is no longer just a falling stock. It becomes a referendum on whether you are weak, disloyal, stupid, or late. That is how people can sit inside obviously dangerous concentration for far too long and still feel principled. They are not only defending a price, they are defending a story about themselves. And when a stock starts carrying career pride, household plans, tribe identity, and personal intelligence all at once, selling it feels much heavier than clicking a button. Most viewers will never have $1.8 million in one stock. That does not put them outside the mechanism. The trap works at smaller scales because the engine is psychological, not numerical. If you have ever stared at a losing position and told yourself you only needed to get back to what you paid, you already know the feeling. If you have ever sold a winner because the open gain felt too precious to watch disappear, you know the other side of it too. The everyday version that matters most is employee concentration. Advisors often say a single stock should usually live somewhere around 5 to 10% of a portfolio. Yet people with RSUs, ESPYs, options, and matching plans can drift to 40, 50, even 80% almost by accident. Not because they bought one giant lump, because they kept not selling what kept arriving. And not selling is still a decision. Company stock has one extra hazard that broad market exposure does not. It can hit the same household twice. If the company weakens, The stock falls, and the job may get less secure at the exact same time. Income risk and portfolio risk stack on top of each other. That is not ordinary volatility, that is fragility. Then, taxes enter the picture and distort it further. A visible capital gains bill feels like a concrete loss. Concentration risk feels vague because it has not happened yet. So the brain does something predictable. It avoids the known bill and accepts the unknown downside. The position starts masquerading as prudence. But if you had the same amount in fresh cash today, would you really build that same one stock allocation on purpose? For most people, the honest answer is no, which means the real reason the position remains huge is not conviction after analysis. It is inertia after emotion. The stock feels familiar. The tax bill feels annoying. The sell decision feels like admitting you might be wrong. That is enough to leave a household far more exposed than it would ever choose from scratch. Let me make the false safety visible with simple math. Imagine a household sitting on $500,000 of gains in company stock. Selling some of it could create a tax bill of 75,000, maybe 100,000, depending on basis and location. That number is ugly because it is precise. You can picture the check. You can feel the money leaving. So people tell themselves they are being smart by waiting. Now compare that known cost with the risk they are quietly carrying. If that concentrated stock drops 40%, 500,000 becomes 300,000. If it drops 70%, it becomes 150,000. If the company breaks in a way the market never really forgives, the damage can be worse than either of those. The tax bill is fixed and knowable. Concentration risk is open-ended, yet the fixed cost usually gets more emotional weight because it is immediate. That is backwards. Paying tax on a gain feels like losing money, even though it only exists because money was made. Risk reduction rarely feels exciting on the day you do it. It feels annoying, maybe even weak. But the alternative is a giant implicit bet that one company deserves to carry a huge percentage of the family's future. A diversified index is not a mattress. It is not surrender. It is still ownership of businesses, still exposure to growth, still participation in markets. What it removes is single company fragility. Compounding cares about that distinction. One quiet way people damage long-term returns is by repeatedly interrupting strong positions when they are green and extending weak positions when they are wounded. Over years, that habit acts like sand in the gears. So when someone says they are holding a very concentrated gain to avoid taxes, I do not hear cautious investor. I hear someone accepting unlimited downside to avoid a limited cost. The fix is not becoming emotionless. The fix is building a system that makes fewer decisions when emotion gets loud. For this case, I think the operating system needs 4 hard rules and 2 flexible tools. Rule 1, concentration cap. If any single stock grows above 10% of total investable assets, trim it back below the line. 8% is even cleaner because it leaves room for drift. The point is not predicting a top. The point is refusing to let one company become the household. And this only works if the number lives outside your head. Total investable assets, current percentage, cap. Action above cap, written down. A rule that exists only as a feeling is not a rule. It is a mood. Rule 2, the 20% checkpoint. If a single stock position falls 20% from a recent high, you must write one sentence explaining why you still own it today. Not why you owned it 6 months ago, today. If the sentence leans on hope, break even, or vibes, sell half. I would make that checkpoint slightly more annoying on purpose. Date it. Put your name on it. Force yourself to use one plain sentence. If you cannot explain the position without reaching for the old high, that is your signal. Rule 3. Vest day is decision day. If your employer pays you in stock and the position is already large, new shares do not get a free pass just because they arrived through compensation. They either earn a place in target allocation or they get sold and moved into a diversified fund. Default matters here. If new stock lands and just sits there by habit, habit will beat intention almost every time. Rule 4. One rebalance date on the calendar every year. Same date, same process. No waiting for a better week. No negotiating with the chart. If the date is January 15th, then January 15th is when the household decides how much one stock gets to occupy, not some emotionally charged Tuesday after a bounce. Then the flexible tools. If the position is huge and taxes are real, use a staged exit, but be specific. Do not write sell some over time. Write the exact schedule. Sell X shares or X% on the first eligible trading day of each quarter until the position is under the cap. Pre-write the lot selection if taxes matter. Pre-write where the cash goes. If the proceeds just sit next to the same ticker in a brokerage app, one green week can suck them right back in. Better to route the money directly into the diversified destination so the path is one way. If there are losing positions elsewhere, harvested losses can offset some of the gains and make the exit less painful. Public company employees have one more layer: trading windows, blackout periods, sometimes automatic plans. Fine, work within them. Complexity is not a reason to do nothing, it is a reason to prepare earlier. If your company only allows sales in certain windows, then the plan should be built before the window opens, not on day one when the chart is moving and your mood is already involved. Know the dates, know the share count, know the order type, know the destination for proceeds. If your role allows an automatic plan, even better. Let the calm version of you handcuff the emotional version. I would also add one anti-self-sabotage rule. No edits to the plan on big emotion days. Not after a 5% rip, not after an ugly earnings gap, not after a scary headline. Those are exactly the days your brain will produce the most persuasive nonsense. The plan can be reviewed later, in a neutral week, on paper. What I would not do is trust future mood. Future mood always has one more excuse. Wait for earnings, wait for the bounce, wait for next year. Wait until it feels obvious. It almost never feels obvious, which is why the rules have to live outside your head. One page, written. Percent cap, vest rule, checkpoint rule, rebalance date, exit schedule, blackout dates, destination for proceeds. Maybe even one more line at the bottom with another person's name on it. Spouse, advisor, whoever is allowed to ask whether you are following your own policy or improvising again. If you want a visual for the whole system, think of a circuit breaker panel in a house. Nobody installs it because they expect calm conditions forever. They install it because one day too much current will try to run through one line. The rules are there to trip before the fire starts. Good investing rules often feel mildly frustrating in the short term. That is not a bug. That discomfort is the price of protecting yourself from the version of you that will sound most convincing right before doing the wrong thing. The ending of the Reddit post is what made the whole case stick with me. He was not asking how to find the next stock. He was asking whether anyone else had been through the same thing and how they dealt with it mentally. And the replies mattered because they showed recognition, not spectacle. People were already living inside the same loop. Concentrated position, old high stuck in memory, better sale point always one step ahead. So I would keep the final message brutally simple. The market does not know your old regrets. It does not care what price made you feel smart or stupid 3 years ago. It does not owe you a cleaner exit because you learned the wrong lesson from the last trade. Every position has to justify its size in the portfolio today, not at the old high, not at your entry today. If I were turning this into one practical exercise, it would be three written questions. If fresh cash hit the account this morning, would I build this same position at this size? If this stock dropped another 30%, what specific part of my life would become less safe? And what rule, not hope, decides what I do next? Those questions work because they drag the decision out of the emotional courtroom and back into the real household. The goal is not to avoid every mistake. Nobody gets that. The goal is to stop one old mistake from recruiting the next one. In this case, the tragedy was not just that the stock fell. It was that an earlier regret taught him to worship the wrong virtue. He thought he was choosing patience, What he was really choosing was exposure without a limit. That is the line I would want the viewer to remember. Diversification is not only about expected return. It is about not letting one chart control your sleep, your marriage, your identity, and your timeline all at once. The win is not calling the top. The win is building a life where one ticker no longer gets to narrate your future.